Anyone know how many SaaS companies went public in 2024? If you were to say less than 10, you'd be right. If you'd say less than 5, you would be right. 3. Yesterday, at a private forum in Europe, Nasdaq announced they have 100 companies teed up for IPO in the next 12 months. So 3 so far this year, SaaS companies, 100 total IPOs. Something is changing. I think the capital markets are impatient. I think investors are impatient. I think we're all impatient. Operators are impatient. We've flushed a lot of stuff out of our business, as you saw. And now it's down to who can hit those windows and get those returns that we've all been waiting for. And it really does come down to GTM efficiency. I'm going to show you. Today, we're going to talk about 3 things. It's all on this one slide. GTM efficiency, what we can learn about efficiency from a factory. That's very brief. And then what the GTM equivalent is for efficiency metrics and how we can go after that systematically, not haphazardly. That's the entire presentation. A startup is an asset class that can turn $1 million assets into billion-dollar assets. It's really the only asset class that can do that. Can't do that with commodities, can't do that with bonds, can't do that with public stocks. Startups are the only asset class that can turn $1 million asset into $1 billion asset. Why? Because we spot opportunities before anyone else does, and then we go do something about it. And we do something that's unexpected. We create value, and we do that not accidentally. We do it systematically through phases. The first phase is all about the product. We spot an opportunity. We go build a product that is super awesome, that solves a job to be done for a specific customer who's trying to make progress in their life. It's all about the product. The second phase, which I would argue most people in this room are in right now, is all about go-to-market. Now that I've got a product that will solve a problem, that's got product-market fit, I got to get it to market. I got to figure out go-to-market fit. Product-market fit over here, go-to-market fit right here. I got to figure out what works and what doesn't. That's what we're going to talk about today. And which 100 companies will make it through that IPO window or the equivalent exit really comes down to who gets this right. Now, in the third phase, it's still all about go-to-market, but there's a little bit more strategy. It's M&A, it's new markets, it's product extensions, but go-to-market is what we are trying to solve right now, and there's pent-up demand right now for who's going to be good at go-to-market, and that's what we're trying to solve right here. If you just look at the income statement, there's a super simple way to just look at go-to-market efficiency. AJ showed this to you already. Here it is in a formula. Take your last 12 months adjusted sales and marketing spend. The only adjustment there is we eliminated stock-based compensation, and see what you got for it. What did you get for it in terms of increase in ARR? That includes all new customer sales, that includes all expansion sales, it also includes all down sales, and it includes all attrition. So just the net change in ARR, convert that to a percentage, what'd you get? So higher is worse. If I spend between less than $2 to get $1 of net new ARR, I'm in the blue here. If I spend between $2 and $3 to get $1 of net new ARR, I'm in the yellow here. If I spend between 2 and 4. If I spend more than $4, I'm in the red here. And there are people spending more than $4 in sales and marketing to get $1 of net new ARR. I'm going to show you that in a minute. So higher is worse. Lower is better, depends on your market, and we're trending in the wrong direction. AJ showed you this data. This is public company data. We're trending in the wrong direction. Is that because we're spending more, or is it because we're growing less? Both. Yeah, both. It's been tough, but like I say, we can get this right, and I'm going to show you that in a second. So here are some public companies that are struggling. You'll notice, not only based on the y-axis, that we're spending more than $2 for every $1 of net new ARR, but most of these companies who are in that category are trending better or worse? Worse. I heard people saying worse, and that would be correct. Yeah, worse, right? This is quarter over quarter data, and I'm spending more and then more and then more. I'm chasing growth with more dollars. We don't, specifics matter here, but if I'm doing more and I'm not getting more for it, and then I do even more and I'm not getting more for it, then I'm doing even more and not doing more for it, then I get trends that look like this, up and to the right. There's another category of public companies that are actually doing well. We looked at 71 companies here. These companies are spending less than $2 for every $1 of net new ARR, and a lot of them are actually trending better. So we can look at this on average, but it's better to look at it very specifically. And in a minute, we're going to get even one click below this because you can't solve the problems at the income statement level. Everybody knows that. But this is just the income statement. This just gives you a directional read on how we're doing generally. And if we want to get out, if we want to get into the public markets, we're going to be competing with these companies and with these companies for investor attention. All right, so GTM efficiency, we're in trouble. trending in the wrong direction. Some companies are getting it right. Some companies are getting it wrong. Now let's look at, if we want to look at efficiency, what can we learn from a factory? So factories go for three things. One is they go for volume. Second is they go for cost efficiency. Third is they go for quality. Just think about any factory, assembly plant. I want volume. I want cost efficiency. I want quality. In GTM, we have the same things, but instead of volume, we'll look at growth rate. That's what valuations are based on, but not solely. Growth rate weighs 2.5 times more than cost, but cost still factors in. I need cost efficiency, which we just looked at, and then I need quality. And quality, the way we measure quality numerically in GTM is through retention and expansion. If we're creating recurring impact for our customers, then they're coming back to us. That's a customer that I can renew. That's a customer that I can expand, and that I don't have to go fill in for after it attrits. So we want high quality revenue, not just revenue, not just more revenue, and not just revenue at all costs, but high quality revenue that I can renew and expand. Okay. And in a factory, that doesn't just happen generically, it happens by production line. And in GTM, it happens by production line also. So we got to think very specific. We're now a click below the income statement, right? So I may have a GTM motion that's manual production, low volume, high touch, high dollar value, but low deal volume, high touch. That's our enterprise motion. On the other end of the spectrum, I may have a high volume, no touch. That's our PLG motion. And in the middle, I have a medium volume, medium touch. That's our SMB motion. And each of those has to be evaluated specifically and measured and monitored specifically. If I were to say, hey, what's my GTM efficiency for the company? I would get the wrong answer. What I need to ask is, what's my GTM efficiency per production line? And I need to get into the details because it may be working for me here and not working for me over there. And I can't solve that by averages. So we got to click in, and each of those production lines has its own inputs, its own throughput, and its own output. We use closed loop data to figure out what's going right and what's not going right, and we treat each GTM motion as its own production line. Quality in GTM is a bit of an issue. I said we measure it by retention. Okay, that's great. But what about what goes into retention and what goes into the quality of building this input, throughput, and output kind of view of the world? In networking, we have ISO 9000 standards. In product development, we've got agile. We've got in manufacturing, we've got lean production. What do we have in GTM as a set of standards? One of the companies that we worked with recently that achieved about 18 months ago, achieved a $6 billion outcome. The CEO said, and I'll just read it, "The state of GTM expertise is woeful. Not enough executives put in the hard work to learn the trade. Revenue generation is the result of repeatable processes." And this is a CEO who had to look hard for the executive team that he thought could get the job done. And they did achieve a $6 billion outcome. And he still says the state of GTM expertise is woeful. We believe that to get to what Nasdaq is talking about in the next 12 months and beyond, we will need to insist that executive teams who are running these businesses are certified in operating a recurring revenue business. So we're going to talk a little bit about that. And every one of you is either, if you can fit it with all of AJ's goodies in his bag, if you can fit it, bring this home with you. If not, we'll mail it to you. But this is a revenue architecture textbook. It looks way more intimidating than it is. Has anyone cracked this book? A few of you. So the margins are wide, the font size is big, and there are a lot of photos. Like, I can read this book. It is a good book, and it goes through principles, which I'm going to highlight 3 of them for you today, but you can bring that home with you. So this is a set of standards. We're going to talk about 3 of those models that are in the revenue architecture textbook and that constitute the operating system that we want to employ to go really look in detail about what's working and what's not. One of the first principles of revenue architecture is do more of what works and less of what doesn't, which means I actually have to get below the level of the income statement. I got to get below the level of company performance, and I got to figure out which of the things that I'm doing, and you saw from that CEO, it's about repeatable processes. If I'm executing a defined process, I should know whether it works or not. I should have a closed loop data on the back end of that. I should know whether that process is working or not, and then I adjust it. So we're going to look at 3 models that help us do that. 1, the data model. 2, the GTM model. 3, the growth model. So let's look at the data model. So first principle of the bow tie data model that AJ mentioned earlier is that recurring revenue starts where the traditional sales and marketing funnel stops. And all of the compounding happens after the initial sale. Everything before that initial sale in the traditional sales and marketing funnel is linear. Add resources, get output. Add resources, get output. Nothing compounds on the left-hand side of the bow tie. If we look at it like this is the traditional sales and marketing funnel leading to an initial mutual commit. And then this is activation, retention, and expansion. That's the rest of the customer journey. That's where all the compounding happens. That's where next month I start where last month I left off. Instead of next month I start from zero. I get the benefit of all the work that I did. In a recurring revenue business, I get the benefit of all the work that I put in. As long as I have a well-retaining customer base, now I can just expand from there and I get compound growth on the right-hand side. I also want to measure this. This is where all my measurement comes from. So these CRs at the bottom, those are conversion rates. Customers make it through this customer journey at a certain pace, certain conversion rate, certain time, certain volume. And if I'm measuring and benchmarking, which we can do, we can benchmark each of those specific go-to-market motions against our peers. Then we can know where it hurts. We can know where we're not quite achieving what we need to. Then we can go assess input, throughput, output, and look at what's working and what's not. So that's a very, very quick view of the data model. It turns out that not all go-to-market motions are the same. We talked about this. We want to align the go-to-market motion with the expected annual contract value that we're going to acquire, retain, and expand. So if you've got a $100, well, let me just show you this. If I've got a $10,000 annual contract value on the x-axis there, then I will run a certain sales motion, a certain prospecting motion, and a certain CS motion. I'm going to run an outbound prospecting motion, a two-stage sales motion, and a volume-based CS motion. But if I've got a $100 ACV, I can't afford to do that. I got to have the product doing all the work for me. That's a product-led growth. Product's got to convert. Product's got to retain. Product's got to expand on its own. It's going to be self-serve. If I've got a $1 million ACV, I'm going to be running a very different motion. I don't want SDRs talking to those $1 million customers. I need to be running an account-based motion, both on marketing and on sales, and then I'm going to have a dedicated motion in terms of CS. And I've got to match my expense and my attention to the expected ACV. That's the GTM model in like 2 minutes. And then all of that aggregates into an overall growth picture. We're not just growing from one production line. We're growing from all of our production lines. These production lines are going to work together. And one of those three IPOs from last year is a company called OneStream. We worked with OneStream to help them get ready for their IPO. Good news for them. Extremely good, and you can see all this in the S1 and the public filing data, so I'm not telling you anything that you wouldn't be able to read. Extremely good at retention. High 90% retention. Extremely good at retention. Less good at expansion. That's okay until you get to about $30 million. But after $30 million, you have to be the combination, that the net revenue retention, the combination of retention and expansion has to be a major driver of your growth. Early on, it's all about acquisition. But later on, it's all about the combination of expansion and retention. That's just the way the math works. That's just the way the compounding math works. When you have a larger base, you have a larger opportunity to expand on that base. Early on, when you have no base, all you can do is acquire. So we shift over time. The growth, we actually shift our focus over time. In the beginning, as a startup, we're trying to figure out what works. This is product market fit. Then we try to figure out what works on a go-to-market basis, do more of what works and less of what doesn't. That's where a lot of us live right now, and we got to get that right. That's revenue architecture. And then grown up and enterprise, we're going to focus on other things. Because the growth model is a pretty well understood journey right now, because we're not doing this haphazardly, we're doing it systematically, we should be able to know what to focus on when. Early on, it's about pricing and packaging, founder selling, getting a base level data model in place so we can measure what's working and what's not, and we can make adjustments. Later on, it's more about sustainability, productivity, interoperability, durability. If we focus on these things too early, we're wasting our time. Like, you can't skip over product market fit and go-to-market fit and just get to these kind of scale-based considerations. Conversely, if you don't do these things right, you're going to run into all sorts of problems. So there's a method to our madness on how we go architect growth and architect revenue. So GTM efficiency, I think there's something in the air. I think we're all impatient about how the last few years have gone, and I think we flushed a lot out of our system, and I think there will be, whether Nasdaq is right that there's 100 IPOs in the next 12 months or not, I think something's changing. Who's going to go get that? The people that get GTM efficiency right. You're going to want to be in the 1 or 200 or maybe 300% GTM efficiency range. You're not going to want to be slogging it out in the 3, 4, 5. I didn't show you some companies at 6, 7, 800%. We can learn from a factory, and we can do it systematically. I slugged it out at Profit Logic, and we sold that company to Oracle. Great outcome. Then I slugged it out with the team at Inside Sales, and we sold that company to Aurea. Not great outcome. That's like selling to CA. Yeah, you get it. Not great outcome. Cash your little non-life changing check and call it a day. It makes a difference. You can spend lots of time and lots of money and lots of energy and get it wrong. We had a great operating team. We got it wrong. It matters. These decisions matter. The specifics matter. The input, throughput, and output matters. The production line by production line optimization matters. The closed loop data matters. This is not a one-size-fits-all fix. So how can we help? GTM Education, everyone's going to get a book today. We also have a revenue architecture certification course. I've taken that course 3 times. I highly recommend it. There's an exam at the end. We've got an advisory service. We've worked with a lot of Marlin companies on both advisory and consulting basis, and we would love to work with you on really getting this installed within your company, this mindset. And that person is not me, but Lauren carries the number for us. She's the Chief Revenue Officer for Winning by Design, and she'd love to speak with you. You'll get all of this in your materials. Thank you for having me, and looking forward for the next 2 days. Thank you.